Joining us in the studio is Andrew Karsh. He helps to manage $4.8 billion as co-lead portfolio manager for Credit Suisse's total commodity return strategy. So you're pretty bullish here.
Great. Good morning. Yes. So yeah, I'm definitely bullish in terms of the commodity space now. I mean, right now, as you said, May was a bit of a tumultuous month. A lot of that really has to do with the global economic sensitivity of commodities as an asset class. And it's something that, again, as people were concerned about the economy after the situation with the Greek debt crisis, as well as the Korean situation and then the Middle East, things tended to sell off as people pulled back from risk across the board. And really now what we're starting to see is people re-entering the asset class in the short term. But really what we see it as as a long-term strategic allocation to benefit people's portfolios rather than a short-term trading strategy where people may feel like they get whipsawed.
Do you invest purely in the commodity, or do you also invest into the companies which are involved with those commodities?
No, we only invest in commodities futures or derivatives on those futures. And the reason that is really because effectively our view is that most people that invest with us really want the macroeconomic benefit of commodities as an asset class. So when they think about what's going on with the supply and demand dynamics on copper, for instance, they want to invest in that actual supply and demand return rather than worrying about the CEO of a copper company taking a decision on their capital structure, which may impact the stock price. I mean, when you think about, again, the stocks in these companies, what are they doing? The CEO is trying to make sure that the performance on the stock is consistent over time. So he doesn't want to be in a situation where if copper is down 50%, his stock follows suit. So they hedge their exposure, rightfully so. And we try and get the pure exposure to the commodities market.
Right. Let's take copper an example. I mean, you're bullish there, but, what about China? I mean, if the property market does cool and take a nosedive, you could be caught the wrong way on that.
Yeah, I mean, the interesting thing with copper in particular is, people have said, well, copper stockpile is building recently. And what we've seen is because of the continued demand for copper generally, that actually in the past few months, copper supplies have started to decline again. And so, again, there's always an ebb and flow in terms of the way that the actual production capacity changes versus supply and demand. But in reality, what we see is a continual benefit in terms of the demand for copper and many industrial metals, as well as commodities in the energy sector as the growth and urbanization strategy in China and countries like India continues.
And oil, of course, as well, another one. I mean, what's your forecast here? I mean, we've been sort of flirting between $70 and $85 the barrel for quite a while now. What's going to take that a breakout from those that range bound sort of scenario?
Sure. I think at least in the short term, a lot of the sort of downside momentum had been really, as I said earlier, due to global macroeconomic concerns. And now what we're seeing is, again, a positive momentum hitting 78 recently this week. So, I mean, it's something that, in terms of the short-term trend, there'll probably still continue to be some volatility as people are trying to vet what's actually going to happen in terms of the production capabilities as well as what's happening in the Gulf of Mexico. But in the long term, we definitely see an upward trend on that. So, I mean, it's something that, again, in terms of the sensitivity, as economies feel more comfortable and investors feel more comfortable globally, we'll see an upward trend in oil as well.
Long term, of course, oil prices are bound to go up. I mean, as we see scarcity coming to the market. But, short term, it's impossible to tell, isn't it, really?
Yeah, no, I definitely think oil is one of the most volatile commodities out there, and there's a real reason for that, and that really is the sensitivity to two things. One being global macroeconomic demand, and more so the concern. And to be frank, the concern for the downside in demand has really been overblown, and we saw that at the end of 2008 where the oil price was at 35 and obviously has rebounded dramatically since then. But really, in terms of the story, it's something that, we continue to see, again, positive momentum. And then as economies become more comfortable with the upward trend in demand, then, that'll obviously be placated by some of the macroeconomic trends. We've seen, obviously, positive momentum in the U.S. And, China, think about what's going on in China. Sold more cars in China last year than they did in the U.S. for the first time ever, and we expect that to continue. All those cars need fuel. Obviously, there's ongoing demand from that aspect as well.
Yeah, Andrew, what about gold now as well? I mean, we've seen the sovereign debt crisis in Europe affect things, and we saw the inverse relationship between the euro and gold, actually, which was something we hadn't seen before. Does that, A, continue? B, are we beyond the crisis now in Europe?
Obviously, some of the news coming out of the G20 over the past few days seem positive for Europe in general and the overall sovereign debt levels. I think people will remain to be seen what's actually going to happen in real terms over the next, 1 to 2 years. So from the perspective of gold, as you mentioned, gold and dollar were correlated for the first time in a very long time over the past 6 to 12 months as people moved out of Europe, particularly the euro, into the dollar and gold because of their security. Gold, what we've seen really the trend over the past few months is, similar to what we saw after, say, World War II, where people use gold as a monetary unit in the storage of wealth.
A currency, essentially.
Exactly. And so it's something that I think, at least in the meantime, it's kind of flattened a bit. Obviously, it's been around 1240 in the past day or so. So it's something that, unless we see another particular hiccup in the global economy or news that's unforeseen, we'll probably see it stabilize around this level for a while. But just fundamentally speaking, I mean, there is an ongoing reduction in the supply of gold in terms of the production side. So it's something that, does have the possibility of taking a big leap up if there's more economic uncertainty.
Andrew, thank you so much for coming in.
Great, thank you.
Andrew Karsh there. He's a co-lead portfolio manager for Credit Suisse's total commodity return strategy.